So what happened in this cycle? And in this particular case, it was oil prices that increased because of the war. And what did that do? Well, that triggered inflation concerns immediately, right? And then the bond market sold off. That pushed yields higher, and that's what we would expect. Mortgage rates followed, but more aggressively than they maybe should have, and that's because the volatility in and of itself is an amplifier to these market moves. So it's not just that rates went up, it's how aggressively they go up. And you guys, this is really a function of the risk associated with volatility. So what happens is mortgage companies, first of all, and it's not just mortgage companies, it's investors in mortgage-backed securities. It's the whole market, right? They get very concerned when there is volatility. So specifically for mortgage companies, the hedging cost goes up drastically during times of volatility like this. They have to really protect themselves. The mortgage servicing rights, right? The value of the servicing becomes less of a stable asset in markets like this. And then investors demand higher returns to compensate for that risk. And I mean investors that are investing in mortgage-backed securities. So lenders widen their spreads to protect themselves and make up for all of those layers of risk that get inserted into a market of volatility. Now, I'll go back to the way the charts look today, which is a month of steady decline in MBS price and 3-day spike up that was like, 50% retracement in just a couple days. Well, why don't we see that in our rate sheet? Because it's not a long enough pattern of stability for that to be reflected yet in the price. And that's why a lot of times there's some sort of an event that triggers rates to spike up. And that's why we say they shoot up like a rocket, but they come down like a feather because the markets and the mortgage companies and the hedging firms and everybody else in the pipeline of the manufacturing of the mortgage process, they have to know that things have stabilized, and it takes time for that stability to take place. So even though MBS has improved, your rate sheet probably did not follow as quickly as you would think that it would. And this is why. There's all these extra layers of risk. Now, we've also priced in this risk over time. So we got to kind of let those loans work their way through the system before you start seeing this really reflected in your rate sheet. Because until those loans fund and get settled out and sold, no one really knows where they are on that kind of vintage of loans as far as profitability goes. So it's going to take some time for that to work through. So all those things kind of play together and mean that rates typically don't recover as fast as they jump up. So even as things stabilize, which I don't know if they will yet, we see a bright spot right now. We see this massive recovery in MBS here at the end of the month. But does that stay? Do the talks with Iran continue to go well? Does the Strait stay open? Do no tankers get blown up? Time will tell, but not really the point of this conversation. So as I said, rates go up quickly. They come down slowly. Consumers are typically confused by this, right? If and even here on this podcast, I've talked a lot about oil prices. And look, if oil went from $50 a barrel to $100 a barrel, everyone knows interest rates go up. But when it goes back down to $50 a barrel, you might look at the interest rates where they were before oil prices went up and said, hey, we're not back to where they were, right? That's another kind of false indicator. Now, I've shown the graphs. There's no question that over time, interest rates and oil are going to trend together. It's just how quickly does that reconvergence take place? And that's really the point that I'm getting to.